your broker knows about you. Hi, it's Charlie giving you today's video. We're back tonight for a live broadcast, in fact. So the what does your broker know about you? Well, there's certain assumptions that a broker will make about a customer of theirs, and they're not looking specifically at every new account that's opened, and and doing something specifically against you as a customer or anything like that. But they will make assumptions, generally speaking, if they see a given sort of an account. So if someone opens up an account with, let's say, 500 in it, whether it's $500 or £500 or whatever, that's a pretty low amount of money. So in order to be able to trade, if you're trading something like FX or CFDs, if you're only putting £500 into your account, then it's fine, you can do it, but it's likely you're going to be taking bigger risks, because even if you put on the minimum trade contract size of 0.01, the risk is that even putting on a size like that, you're going to be probably risking 2, 3, 4, 5% of your account, because you're restricted that this is as low as you can go in position size. So you can trade, but you're going to be risking more with a given stop loss than other traders normally would. So they'll make an assumption that someone who opens an account with a small amount of capital is more likely, it's not a definite, but it's more likely that they'll wipe out. That's the bottom line. It's just more likely. It's not a definite. So if you're sitting there saying, yeah, but I'm going to put £500 or dollars into a trading account, yeah, it's just more likely, because someone who puts a small amount in is more likely to gamble it as well. And so that's the main point there, that they're not going to be able to trade at 1% or less risk per trade. So they're more likely to be risking 2, 3, 4, 5% or more, plus the potential. They know more often than not, someone who puts a smaller amount of capital into an account, they're just going to try and trade, try and double it as quickly as they can or whatever. So the flip side to that is that there's a high percentage of those people that will just essentially blow the account. So I don't want to put people off who are going to do it as diligently as they can, but those are the things that the broker just knows, generally speaking. Lastly, another thing that a broker knows, if I come back to the stock markets here, brokers love, looking at the S&P here, brokers love volatility. They love market volatility. Why? Because it encourages traders to trade more. So when the markets come down, like the S&P had been doing or has been doing over the past month, let's say, volatility picks up as fear comes in, generally with investors. But of course, traders, it does present more opportunities because there's more volatility going on. However, the risk is that traders get excited and therefore they overtrade. Now, brokers like that because why? It gives them more commissions, because they're earning on every trade, and I've spelt that wrong. So if a trader starts trading more frequently, then the broker earns more money. Now, there's nothing wrong with that, and if a trader's trading more, but I'm just saying what your broker knows about you is that if the market volatility picks up, then traders tend to trade more. But we all do, because there's usually means there's more opportunities. But with some traders, they get overly excited and they then overtrade, which all it means is you end up making your broker a bit more money in commissions. So just a couple of things to consider there today. So even in times of market volatility, yes, your natural trade frequency might go up, but just be careful not to be getting overly excited, so to speak, and just question whether you're edging yourself into the over trading label rather than just, yes, your trading has gone up because there's more opportunities. Just try and get that balance there. Anyway, I'll be back on Saturday for a trading story if I don't see some of you tonight.